welcome to chapter 23. In this chapter, we're going to be talking about homeowners insurance, a continuation from chapter 22. Let's start out with personal liability. So personal liability, this is going to be coverage in Part E of your homeowners insurance. And the coverage is going to protect you when some claim or suit for damages is brought against you because of bodily injury or property damage, allegedly caused by your neglect. So if you're liable for damages, the insurer will pay up to the policy limits that are legally obligated to pay. Now, those limits are going to be set within your homeowner's contract, but they can include costs for defense as well. Now, so the minimum amount of liability insurance is $100,000 for each occurrence, and the occurrence is going to be applied to a single limit for both bodily and property damage. Now, an occurrence is defined by an accident including continuous or repeated exposure to substantially the same general harmful conditions, which results in bodily injury or property damage during your policy. So this is something that is going to be covered in Section 2 of your homeowner's policy that you should be aware of. Now, let's look at coverage, a little closer at coverage E. So what could happen here? There are certain circumstances where, you're going to need legal defense when a suit is put against you for anything related to bodily damage or injury that you could possibly be sued for. So your homeowner's insurance is going to kick in to help settle the claim by either defending you in court or paying a settlement out of court, depending on what the particular circumstances are in the matter. So it's important to, it's definitely important to have this insurance in case of, here's some situations that could occur where your liability coverage is going to be covered. Now, what if your dog bites somebody? That's generally going to be covered. What if you have a fire pit in your backyard? A lot of people like to have these fire pits in their backyard to sit around. Some of these are, recreational, and this causes your neighbor's house to go on fire. Well, in that case, you would be covered. Somebody in your house falls down and sues you for bodily injury or for damage to their knees, then you would be covered. So this Part E can be very useful, if you know that you have this coverage. Now, Part F is going to be, think of it as a mini accident policy. So this part of a homeowner's policy is going to be focused on medical payments to others, not based on legal liability. So liability is one thing that we discussed before. Medical payments, which is covered by Part F, is going to be coverage for anybody who is going to require, who incurs the cost of medical treatment, is going to be paid to others. So the medical expense of another person who is accidentally injured while on your property or insured location by the activities of the insured, a resident employee or an animal owned in the care of the insured, the coverage will be applied. So if somebody, breaks a bone in your house, the medical bills will be paid. A child, your friend has a neighbor's child over and you're playing and he gets hurt in the backyard, your policy will cover the medical expenses. So this is before, say your dog bites somebody, there can be legal liabilities, but there's also medical liabilities. So Part E will cover your legal liabilities, and Part F will cover your medical liabilities in case of a dog bite. And that's why, a dog bites, you got to be very careful if you do have a dog that they're trained not to bite people, because it can be a really bad situation. Okay. Now let's look at some exclusions to coverage in E and F. Some of these exclusions are going to arise out of assets that should have their own insurance. So if you have an automobile or boat or a helicopter, these items should have their own insurance. So if liability arises in the involvement of one of these vehicles, you would have to go to your vehicle insurance for that coverage. Part E and F would be excluded from giving you any coverage in the liability section for these vehicles. If the intent was to injure or a result was expected injury, you're not going to be covered. So if you purposely break someone's arm, or you do something in the backyard you know is going to wind up to you getting hurt, you're not going to be covered. Business activities, this again, professional services and business activities should have their own separate business insurance, and that's why your homeowners will not cover it. Also, if you're in an uninsured location, your home insurance is not going to cover you for activities in an uninsured location, not near your house or on your property. Other exclusions, if there's a war, Part E and F would not be covering you. If there's a transmission of an infectious disease, you're not going to be covered for legal expenses. So even if someone comes over your house who is sick and gets you sick, your home insurance will not cover that. And again, it's going to look to your main health insurance to cover that. Bodily injury or property damage arising out of sexual assault will not be covered. Corporal punishment, if somebody slaps your child very hard and your child is embarrassed and there's mental abuse resolved in it, although it's very tragic and horrible that this occurs, your home insurance is not going to cover it. Now, let's hope nothing like that ever happens in your house, but these are things you need to be aware of what your home insurance will or will not cover. Liability arising out of the use of sale, manufacturing, delivery, or transfer of controlled substances, whether legal or illegal, will not be covered as well. Now, something exclusive to Part E is going to be contractual liability, will not be covered. So these are exclusions that are only apply to Part E. Property owned by the insured. So if you own property is damaged, you will not be insured in Part E. Property in the care of the insured with some exceptions will not be covered in Part E. Workers' compensation, that should be, usually workers' compensation is not going to be covered because that should be the person's own workers' compensation policy that should cover them. Any liabilities arising from nuclear energy or bodily injury to the insured will be excluded from coverage of Part E. Now, things that are exclusive that won't be covered under Part F, and only Part F, would be injury to a resident employee off an insured location, workers' comp, injury resulting from nuclear energy, or person regularly residing on the insured location would be excluded from Part F. Okay. Now, some additional coverages for homeowner policies automatically include several additional coverages. Typically, claim expenses, which are going to be legal and court fees, are covered. First aid expenses, any first aid expenses occur, will be covered under the policy. Damages to the property of others up to $1,000 will be covered. So if you damage someone else brings an expensive camera over your house and you damage it, your home insurance will pay to repair or replace up to $1,000. Okay, so there are limits to liability, so that the insurer's total liability coverage under Part E for all damages arising from one occurrence will not be more than the limit shown in the declarations. So there is a limit to the liability. The insurer's total liability for medical expenses for bodily injury to one person resulting from an accident will not exceed the coverage F limit shown in the declaration. So again, there are limits to how much will be covered under these conditions. Now, duties after an occurrence occurs. So if an occurrence does occur in your house, then written notice of the event must be provided to the insurer, including the time and place, the circumstances, the names of any claimants and witnesses, as much detail as possible. And the insured person must provide written proof of a claim and authorize the insurer to obtain copies of medical records for the person who is injured. So these are just things that have to be done, and if they're not done, it could limit the ability to get your payout for that. Also, the insured may not sue the insurer unless the insured has compiled and complied with all the forms and conditions required in Section 2. Insurance is excessive over other valid collectible insurance, with some exceptions, and no coverage is provided to an insured who concealed or misrepresented any circumstance or material fact in the coverage. So yeah, that's a bad thing to do, any type of fraud or concealing facts or misrepresenting situations. It could result in you not getting paid for your insurance claims. Now, there are a couple of additional endorsements that can be additionally added to your homeowner's insurance. One could be inflation guard endorsement. Now, the inflation guard endorsement is going to help because the cost of the home and the value of the home changes over time, and this is because of inflation. So as anybody knows, home prices, home values do increase. So if you have insurance that doesn't keep up with the inflation, you could wind up in a situation where you don't have enough insurance to replace your home. Now, and many insurance policies may only pay up to 80% of the replacement cost of your dwelling. So there is a situation where you want to add this inflation guard to your homeowner's policy, and the endorsement is designed to be able to keep up with an annual pro rata increase to the limits of the insurance. So that way, and this percentage should be stated whether it's tied to inflation or 3 or 5%. And this is going to help keep your policy up to date with the correct valuations of today based on these inflationary forces. So that way you don't get stuck not having enough money to rebuild in case of a major event. Speaking of major events, you can also add on its earthquake endorsement. Now, earthquakes are not normally covered by homeowners insurance, and earthquakes, landslides, volcanic eruption, avalanches, these are all things that can really damage your home. So, an earthquake can certainly cause a total loss of your property. And if you live in an earthquake zone such as California, it's probably a good idea to get additional earthquake insurance. Now, earthquake insurance is expensive. There can be high deductibles. So it's definitely something that's not normally, if ever, provided in the typical homeowner policy. So having additional coverage can be expensive in areas, of course, where earthquakes are prone, but less expensive in areas where earthquakes are much less common. So, and, if you live in Hawaii, volcanoes can be a significant issue, as well as some other parts of the United States, and should be looked at pretty closely. Now, let's also talk about an add-on, a personal property replacement cost loss settlement endorsement. So, now basically what we're talking about here is if you have losses to personal property on the basis, you want to hopefully have that replaced on the actual cash value. However, personal property replacement cost loss settlement endorsement can be added to the policy. So under this endorsement, claims are paid on the basis of replacement cost with no deduction for depreciation. And the depreciation is where the value of an asset depreciates over time just due to normal deterioration of its quality. So you don't want it to be replaced. If you bought something for $500 and today it's only worth $100, but a replacement cost would be $600, you want to be compensated not for the current value of it, but for what the replacement cost would be. And this is sort of what this endorsement will do. And it's going to apply to personal property such as awnings, carpets, rugs, appliances, some outdoor equipment. And if these things are damaged, then you can get a replacement at the time with no additional loss to you. So you get the full repair cost, the full replacement cost. And this is something that is worth it because there are many things that you might buy, have for a long time, and then, the replacement costs are substantial compared to what the current value of your property is. So the replacement cost endorsement excludes certain types of property such as antiques, fine art, collector's items, souvenirs. This type of property would not fall under this condition. So the general rule is you should consider adding the replacement cost endorsement for personal property to your homeowner's policy, and usually cannot find used property that replaces the exact same property that's lost. So also, because of depreciation, the amount paid for the loss is based on actual cash value policy could be substantially lower or less than payable based on a replacement cost. So again, this will protect you in case, basically guarantee that you're going to get enough money to replace the item that has failed, which is a good thing. And this is something that a lot of people don't realize when the insurance kicks in. So if we look at a scheduled personal property endorsement with agreed value loss statement. So the homeowner policy has limits to the amount paid for certain personal property losses, such as theft on jewelry and firearms. So the insured you might have a significant amount of firearms or jewelry, and you may want broader coverage than what the basic household policy is going to provide. So if you own some valuable items, such as expensive cameras, musical equipment, jewelry, fine art, antiques, comic book collection, then you can list the property in a separate schedule and insure it for a specific amount. So this is basically, you're going to break out a separate schedule and say, I have these items that I want to have specific insurance against direct loss, and these are the values that we're stating for these items. So it would be an add-on rider to your homeowner's insurance, and that could be a very valuable thing if you have, maybe you have a $40,000 coin collection that you want to have, verified and insured and attached to your homeowner's policy. Now, there's also personal injury endorsements. So the homeowner's policy covers only legal liabilities arising from or out of bodily injury and property damage to someone else. So personal injury coverage, which should not be confused with bodily injury coverage, can be added to the homeowner's policy. So personal injury means legal liability arising out of the following: a false arrest, a detention, imprisonment, a prosecution, a wrongful eviction, wrongful entry, invasion of your space, oral or written publications of material that slanders you or libels you, oral written publication material that violates your own right to privacy. So these are things that can be also added to your insurance policy. Now, if you wanted to, I don't suggest adding any of these to your homeowner's policy because it's going to increase the frequency at which you may file a claim, which we'll talk about later when we talk about the cost of insurance and how that affects the cost of insurance. But you can add an endorsement for watercraft, such as boats and sailboats and power boats, to your insurance policy and have coverage in case there is any type of damage or lawsuits associated with these crafts. A home business insurance, if you're running a business or out of your home, you can have additional business coverage, and identity theft coverage in case you become a victim of identity theft. Now, these things can occur, but again, I always advise to have separate insurance for these types of issues, because you don't want to keep enacting your homeowner's insurance, because that's going to count as a claim and can be used against you in the future as far as when they're setting rates on your policy. So let's move over to the cost of homeowner insurance. So, and just to step back for a second, as far as identity theft, you may already be covered through certain credit cards, through certain other insurances that you have, even car insurance in some cases. You may already have coverage in these areas. So it's something to kind of look at or think about before you get any of that. Or also, additional identity theft coverage is very inexpensive that you can get for less than $10 a month, where they'll monitor your credit and give you identity theft support for a very low amount. And if something does happen in this area, which is quite common that it could happen, you don't have to enact your homeowner's policy, because this is going to increase the cost of your policy. And we're going to get to that in a minute when we talk about specifically prior claim history. That's how it's going to wind up, costing you. Okay, so let's talk about the cost of homeowners insurance. So what's going to factor into what your homeowner insurance costs? Well, there are many things. And we're going to go through this. We're going to go through these one by one. Let's start with construction. How is your home built, and what type of construction is your home? If your home is made out of straw, you're going to have very expensive homeowner insurance. If your home is made out of paper, again, your homeowner insurance is going to be very expensive. But if your house is made out of cinder block and brick that is fire resistant, it's going to cost less to insure than a wood home, a wood framed home. Because the brick home is a lot more durable in weather-related events and also fireproof. Now, location is going to matter too. Where is your home located? If your home is located in an area that's prone to a lot of potential hazards, such as wildfires, hurricanes, or it just has a high crime area, so anything that could increase the likelihood of a claim statistically is going to increase the cost of your home insurance. Also, if your home is located in an area where home values are very high, there's some parts of the country where the cost of buying a home is 3 times the amount the average cost for the nation. You're going to pay more in insurance because you're covering a larger amount of value. Okay, so all the territories are rated. The insurance companies keep statistics in all the territories as far as number of claims filed, the average size of the claim. All these things are going to factor in, because what the insurance company is going to do at the end of the day, no matter what the insurance company is, home or auto, they're going to take all the statistics in. They're going to look at all the claims paid. They're going to look at all the factors that they can about you, about your home, about your area, and they're going to try to come up with a rate that's going to guarantee them a profit based on a big enough pool of people. So they're playing a numbers game, and they want to make sure that on average, you're going to pay more than you're going to receive on average for your insurance claims. So how it works is most people won't use their insurance, and the few people that do use the insurance typically need it for, sometimes a full replacement cost of your home. So the profits they make off of some people who don't use their home insurance helps to pay for the people who do, with money left over for profit for the company. Moving on to fire protection class. So this is going to look at how good is your local fire department, how close is the fire hydrant to your house. These are all things that are going to rate how what your fire protection class is. So it's going to look at the water supply of the fire department, homes in the area. Do you have a higher rate of fire in the area? How close are the homes to each other? If one home catches on fire, is it likely your house will catch on fire? So these all will be part of your fire protection class. And since fire is the most expensive element of what insurance companies pay out, this can be a significant savings if you have a good fire protection class rating. Construction costs. Is it a high cost of materials and labor in your particular area? to repair or rebuild your home. The higher the construction costs, both overhead, labor, and materials for your home, they're going to factor in the higher insurance will be to compensate in case that arises. The age of the home. How old is the home? Older homes are more of a threat to insurance companies, and typically those home insurance policies are higher than newer homes. So the age of the home is also a big factor. Now, it's also true that newer homes tend to be bigger and more expensive. So sometimes an older home that's less expensive and smaller, it may even out just because the total amount of liability is not that much different. Okay. Types of policies and deductible amounts. So the type of policy you have and the add-ons you have to the policy, the coverage you have, the amount of deductible amounts you have is all going to factor in the cost of the policy. So the higher your deductible limits, the lower the cost of your policy. The less detailed and the less uncompensating your policy is, meaning less situations that they're going to pay you money, the lower the cost of your policy. So it's all going to come into play. Now, insurance score is really a credit score. So the credit score is going to look at how well you are managing your credit, paying your bills on time, how high your credit score is. So if you have a low credit score, they're going to associate this with someone who neglects their financial health, their financial credit, and say that if you neglect your financial credit and you maintain your financial credit poorly, then you must maintain your house poorly, and you must be a bum and should be charged more because you're more of a threat and more likely to file for insurance. Now, I would say that this seems unconstitutional, unfair to both auto insurance and home insurance do this. So they look at your FICO score to figure out how much you should pay for car insurance. And it's completely unfair. But this is, they found correlations between bad credit scores and more frequent claims for both auto and home insurance. So they'll charge you more if you have a poor credit score, even though the causality is not direct of this. So it's very important that you always keep the best credit score possible to avoid this. Now, getting back to what I was saying before about prior claim history. These insurance companies have an exchange. So they're all going to be little snitches and report any comprehensive loss to this exchange, the CLUE exchange, the Comprehensive Loss Underwriting Exchange. So all the insurance companies are going to rat you out and establish that you've reported a claim. And then when a new insurance policy is issued, they're going to look to this report to see how many claims you have filed. This is one of the reasons I was saying before that you don't want to tie everything to your home insurance, because that's going to result in more claims. And the more claims you have, the more insurance you're going to have to pay. So your history of reporting claims is important, and you want to try to avoid a lot of the small claims you could easily cover yourself. So if you have a $500 deductible and you're putting a claim in for $900 and you're only going to receive a $400 compensation, it's not worth it to put the claim in, because this can increase your home insurance by $100 a month, a year. So you can wind up getting the $400 from your homeowner's insurance, but then paying thousands of dollars of extra homeowners insurance costs over a multiple year period that, it hardly makes it worth it to file a claim unless it's a significant claim, because they're reporting all of these loss to the CLUE exchange, and they're going to use this to figure out how much to charge you for future properties. Now, and this is why these loss history reports are controversial. So why should I pay more because I had to use my insurance for a legitimate claim? And then you get branded as a claim user, so they want to charge you more because you're someone who's likely to put the effort in to file for a claim. Now, but insurers will say, well, in our defense, if a house has a lot of claims against water damage or mold or other sorts of repetitive losses, we want to know about it so that we could go in and be forewarned that this house is a higher risk than normal for claims being issued. So that's what their defense would be of it. Now, this loss history report, is going to indicate these previous claims, and that's going to be harmful for trying to obtain insurance on that house. So you may have a problem selling your house or getting the best price if there's a lot of insurance claims on your house. And if you're buying a house, it might be good to consider looking at the amount of claims that were filed on the house for home insurance to get an idea of, how this is going to affect your rates, or two, possibly how this house could be a problem for you moving forward if typical things keep going wrong with it. Okay, so let's look at some buying tips for buying a homeowner's policy. So let's look at some tips here that could be useful. Make sure you carry adequate amount of insurance. So make sure you know how much insurance you really would need for your property, or make a certain add-ons to really make the insurance tailored to what you need. So your home is going to be insured up until at least 80% of the replacement cost. So that way, I would say try to get insurance policies and cover up to 100% of the replacement cost of your house, as well as paying for temporary housing in case something happens to your house, to help reduce the amount of out-of-pocket expenses that you'll have to pay if something does happen. So make sure that you have the necessary, you're carrying adequate insurance for your home situation. As far as necessary endorsements, I'm kind of going to go clockwise around here. We want to look at, it may be beneficial to put some additional endorsements on your policy, like earthquake or flood, like I had said before, or if you have expensive additional property in your home, to get additional endorsements to cover all that. But you want to be careful not to make your homeowner's policy so inclusive that you're filing too many returns on too many different possible things that could go wrong. Because you could get separate insurance for other valuables in your home, or for earthquake or flood, so as not to burden your homeowner's insurance in case a claim has to be filed. As we just learned how that can be bad. Shop around for homeowner's policy is important, because they're all going to have very, very wildly different rates. So you do want to shop around. You want to look for not just the lowest price, but you want to look for a combination of price and coverage. And also you want to look for, is the insurance company reliable? Do they give their insured people a hard time when they try to file their claims? So you could look at the Better Business Bureau or some other internet rating agencies to see, how are these insurance companies if something does go wrong? Are they a real pain? Are they trying to shirk their responsibilities, or do they pay out promptly? And so things of this nature, you want to really kind of look at the quality as well as the price and the quantity of the insurance you're getting. So it takes a bit of research to really know what the best company is to pick. Now, additionally, what can occur is insurance creep. So for car insurance, or home insurance, even cable TV, you get a situation where there's aggressive discounting for you to establish the policy. Once the policy is established, they know that a certain subset of people are unlikely to cancel and replace the policy. So they will continuously increase the cost of the policy aggressively in hopes that you're not going to switch over to another company. But will get to a point where, you had your initial car insurance at $500 every 6 months or every year, and now it's doubled or tripled. You definitely should shop around. The same thing could happen to your home insurance. It happened to me where my home insurance went from $800 a year to $2,400 a year with little or no explanations, where they just figured that I wouldn't shop around or change my insurance, which I did, and got it lowered back to I think it was $900 a year. Same thing with my cable TV. Every once in a while, my internet and cable TV starts out reasonably around $80 a month, and next thing I know, it's $200 a month. Again, I have to, either shop around, switch the account to somebody else's name in the household to get those introductory rates. So you have to be careful that a lot of these types of companies will prey on people who don't want to go through the hassle of changing their insurance to get a better rate. But if your insurance winds up getting to the point where it's doubling your initial cost, you definitely should shop around. Okay, so consider a higher property insurance deductible. If you want to have a lower rate, I usually, instead of taking the $500 deductible, which is pretty standard, I usually go with a $1,000 deductible. Because if there's going to be some damage to my home that's $1,000 or less, I'm not going to apply for insurance coverage anyway, because it's not worth the additional cost to my future premiums by filing claims on my insurance policy, my homeowner's insurance policy. So I would only use my homeowner's insurance policy for very significant costs. So if something very significantly occurs, that's going to be a $50,000 or $100,000 or a $300,000 insurance payout, then I will use my homeowner's insurance. But I'm not going to use it for a broken window, small amounts of damage, less than $1,000. So if I'm already inclined not to use my insurance except for emergencies, I'm going to look for the higher deductibility and just save on the annual savings. So I could wind up saving $400 or $500 a year by having a higher deductible. After 2 or 3 years, I've saved more money than what I would pay out in the deductible anyway. So it's important to look at that, getting a higher deductible to lower your annual rates. Take advantage of discounts. Certainly want to take advantage of discounts. Common discounts. One big discount you can get is if you bundle your homeowners and auto insurance. You can get very significant discounts by bundling. So always check out the bundling. You can get discounts for being a student, being in the military services, being a veteran. You can get discounts for improvements to your home, fire alarms, theft alarms, smoke alarms, sprinkler systems, extra deadbolts on the doors, fire extinguishers, things, all these things. Ask your insurance companies what discounts they offer and see if you're able to do these minor upgrades to get these discounts. They can be significant. Now, if you live in a place that's prone to flooding or earthquakes, get the additional insurance. Now, you would want, I would say, get 2 quotes. Get a quote if it's included in your normal home owner's policy, and get a quote if you buy it separate from a separate company that's not connected to your homeowner's insurance, and see what the quality of the coverage is and also what the cost of the additional coverage is. So if you live somewhere where earthquakes and floods are very common, this can destroy your home, and your regular home insurance policy won't give you anything. So there will be significant financial impact here. So, and maybe worth it to have this additional coverage because their homeowner's insurance isn't covering it because it's likely to happen and be a total loss. So that's why you want to make sure you're covered if you're in the event of that happening. Improve your credit score. So if this will help you with your homeowner's insurance, with your auto insurance, with your life insurance, with the cost of loans that you take out, the rates on your credit cards, your credit card deals, everything. So you want to really, everybody, even if you want to rent an apartment, they're checking your credit score. So they check your credit score for everything. It's very simple to have a good credit score. Number 1, don't pay anything late. Always pay on time. Set your automatic payments up on your credit cards. You just set an automatic minimum payment so you never miss a payment. Make sure you have a long credit history. Don't cancel credit cards that you've had for more than 5 years. The longer you have these accounts open, the more benefit it is to your credit history. Remember, the credit report or the credit score isn't necessarily looking at, oh, you're a good person, you always pay off your balances in full. No, they look at, are you a good customer, meaning that you pay some interest, that you have accounts open for a long time, that you use your credit. So it's not just, don't think of it as you're someone who, the credit score is one part, you're someone who's reliable, another part, you're someone they can make money off of. So to get the higher credit score, you want someone who uses credit, pays some interest, doesn't always pay the balances off in full. And this helps to get you a better credit score. And you can easily look up online how to get better credit scores. This is not the class for that, but you can easily check that out. Consider purchasing a personal umbrella policy. So this can provide an additional $1 to $10 million of additional liability insurance after the underlying coverage has been exhausted in, your home insurance or your auto insurance. So it also covers liability arising out of personal injury, including coverage for libel, slander. So the homeowner's policy does not cover personal injuries without an endorsement attached to it. So this additional umbrella policy will help significantly provide you additional liabilities for other circumstances if you exhaust the current pools of insurance that you have set up at these sometimes lower minimums. So this is something that you can do to save money as far as if anything happens where there could be a tremendous amount of liability exceeding your home or auto insurance. This could help cover those excesses. And you could also wind up maybe even looking to get lower basic coverage on your home and auto, knowing that you have this umbrella policy to back you up. Couple final things to remember about your homeowner insurance. Make sure you insure your house for the value of cost of rebuilding rather than the value of the real estate. So your real estate value of your house may be $2 million, but the rebuilding cost may only be $500,000. You only need the insurance to rebuild. You don't want to pay extra money on real estate value. You want to pay the money on the actual cost to rebuild your home, because the insurance is going to rebuild your home and you're going to have that same real estate or even better real estate value. So you don't need to pay extra to cover real estate value, only to cover the cost to rebuild your home and its contents of the home that you want to have insured. Now, and of course, like I mentioned before, you don't want to select the home insurance company by price alone. You really want to check, what is the financial health of this insurance company? Are they well known? Are they reliable as far as paying out money and treating their customers well and having good customer care and customer service? So those are other things you want to think about. Now, be careful about the flood insurance. So damage from flooding is generally not covered under standard homeowners or renters insurance. So coverage from a national flood program, as well as some private insurance, is definitely beneficial if you live in an area where flooding is pretty common. So, a better way to say it, before purchasing a home, check with the National Flood Insurance Program to determine whether a property is situated in the flood zone. So you may want to consider a less risky area, and not buy homes that are, below sea level or at risk of flooding, because this is going to significantly add an additional expense of having to pay for expensive flood insurance, if you can even get it in some of these areas. Now, when you purchase the, say, auto insurance, you might as well pay for extra coverage, extra liability coverage. So don't go for the minimum amount of legally required coverage for your car. Getting higher amounts, doubling or tripling the minimum, doesn't cost that much extra. Maybe $30 a year, $50 a year. But it'll significantly help safeguard you against liabilities. Now, one way to save is you could, as we discussed, drop collision in older, less valuable cars. But you always want to increase the liability amounts no matter what car you drive. And make sure that if you are renting, you don't neglect your renter's insurance, because if you have especially if you have significant assets. If you don't have any assets worth anything, I wouldn't worry too much about the renter's insurance. But if you have a lot of expensive personal possessions, you may really want to consider the renter's insurance, because it is pretty inexpensive and worthwhile. Okay, so that's it for chapter 23. I'll see you again for our last chapter in this series, which will be chapter 24. And in this chapter, we're going to discuss more property and liability insurance coverages. Okay, talk to you then. Take care.